The ETF with the lowest expense ratio is not always the lowest cost investment because the expense ratio is only one part of the cost. The fee is only the headline cost. A 3 basis point fee gap can look important, but one wide spread can erase years of those savings. Most ETF comparisons stop at the expense ratio, but that fee is only one part of the total cost. Your real cost depends on how you interact with the ETF. If you buy once and hold for years, the expense ratio often dominates total cost. If you trade frequently or rebalance tightly, execution cost can dominate the fee. By the end of this video, you'll know which cost actually dominates for your portfolio. Here's the allocation fork. If you buy once, add occasionally, and hold for years, then the expense ratio is usually a meaningful part of total cost. If you trade frequently, rotate exposures, or rebalance tightly, then the expense ratio can be a minor part of total cost. If your position size is small relative to daily dollar volume, then execution costs can stay bounded. If your position size is large relative to displayed liquidity, then execution costs can dominate the expense ratio. If you hold only US equity beta, then tax and withholding complexity can be limited. If you hold international equity, emerging markets, small caps, or credit, then structural frictions can exceed the stated fee. Identify these yourself, then evaluate the ETF as a cost structure, not a fee label. An ETF has two cost layers. One layer is internal and one layer is external. The internal layer is what the fund deducts or absorbs inside the vehicle. The expense ratio is in this layer. Index licensing costs, operational expenses, securities lending revenue also sits in this layer as an offset when it exists. The external layer is what you pay when you interact with the ETF. You pay it when you enter, when you exit, when you rebalance. The expense ratio is predictable. External costs are conditional. The clean way to define realized ETF cost is realized cost is approximately tracking difference plus your trading costs plus your taxes. Each term transmits into your portfolio through exposure and position size. Expense ratio is not tracking difference. The expense ratio is the stated annual percentage. Tracking difference is the realized gap between the fund's return and the index's return. Tracking difference can be better than the expense ratio, or it can be worse than the expense ratio. Tracking difference is driven by implementation mechanics. It's driven by reconstitution timing, dividend reinvestment timing, and by tax treatment inside the fund. A low expense ratio does not guarantee tight tracking. A high expense ratio does not guarantee poor tracking. Tracking difference is the first place the low fee equals low cost assumption breaks. Execution friction can dominate the fee. You don't buy an ETF at its net asset value in the secondary market. You buy at the offer, you sell at the bid. The difference is the spread. The spread is a direct cost of interaction. It's not part of the expense ratio. It's not refunded to you later. The spread is a function of liquidity and risk transfer. It widens when market makers face inventory risk, when volatility rises, and when the underlying market is closed or less liquid than the ETF's listing hours. Execution friction also includes price impact. Price impact grows with order size, with urgency, and when displayed depth is thin. 1 basis point fee is irrelevant if you cross a wide spread repeatedly. A 3 basis point can be acceptable if spread and impact are consistently tight at your order size. Liquidity is conditional, not constant. ETF liquidity has two sources. One source is secondary market trading volume, and one source is primary market creation and redemption. Primary market liquidity depends on the underlying basket. If the underlying basket is liquid, authorized participants can hedge and create efficiently. If the underlying basket is illiquid, hedging costs rise and spreads widen. This matters for exposure selection. US large cap equity is usually structurally liquid. Small cap value, emerging market small cap, and high yield credit are usually less liquid. Low expense ratios are common in structurally liquid exposures. They are less informative in structurally complex exposures. Cost is produced by liquidity structure, not by fee branding. Position size changes cost transmission. The relevant question is not, what is the spread? The relevant question is, what is the spread and impact at my trade size? A $5,000 trade can execute inside quoted depth. A 500,000 trade often consumes depth and moves price. A 5 million trade forces execution strategy decisions. When your position size increases, your costs move from published to experienced. The expense ratio stays linear, execution cost becomes non-linear. Your interaction cost is conditional and scale sensitive. Now we escalate through structural variables that change the realized cost profile. Variable 1. Interaction frequency. If you hold a core ETF with low turnover in your own account activity, you pay the spread infrequently. In that case, the expense ratio and tracking difference carry more weight. If you run tight rebalance bands and trade monthly, you pay the spread and impact repeatedly. In that case, external friction becomes a recurring cost. This is an allocation issue. A high-frequency rebalance process increases the cost of holding less liquid exposures. Your holding period is a cost multiplier. Allocation implication. If you rebalance frequently, then choose exposures where secondary market execution is consistently tight at your trade size. If you rebalance infrequently, then tracking quality and tax structure rise in priority. Variable 2. Capital scale and order construction. At higher capital, the ETF becomes a venue. Your orders become a liquidity event. The key decision is not which ETF has the lowest fee. The key decision is which ETF can absorb my order with minimal impact. This connects to share class design. Some ETFs concentrate liquidity in one ticker and one listing venue. Some exposures are split across multiple similar products. Liquidity concentration changes fill quality. Execution method changes cost. Market orders convert uncertainty into cost. Limit orders convert time into execution control. Time sliced orders reduce instantaneous impact. Single ticket orders increase impact. Allocation implication. As position size rises, you should treat liquidity adjusted cost as part of exposure selection. You should also treat trade protocol as part of portfolio mechanics, not as an afterthought. Variable 3. Volatility regime. Spreads widen in higher volatility. This is not an opinion. It's a structural response to higher hedging cost and inventory risk. For a broad US equity ETF, widening can still remain modest. For credit, small caps, or emerging markets, widening can be large. In some markets, the ETF can price continuously while the underlying reprices slowly. That gap becomes spread. If you rebalance into volatility, you often trade when spreads are least favorable. That turns a disciplined process into a cost amplifier if it's not designed around liquidity. Allocation implication. If your process requires trading during volatility, then avoid exposures where spreads and impact widen materially at stress. If you can delay trades, then you can reduce execution friction without changing long-run allocation. Variable 4. Portfolio combination effects. Costs interact across holdings through rebalance flows. A portfolio with several illiquid satellite ETFs forces more frequent trading across less liquid books. A portfolio with overlapping exposures increases turnover at the portfolio level. Overlapping matters because you're effectively rebalancing the same factor risk into multiple wrappers. That increases activity without adding exposure breadth. This is not about too many funds as a simplification. This is about risk transmission efficiency. If two ETFs deliver similar factor exposure, you can consolidate exposure to reduce rebalance trades. Allocation implication. If you run multi-ETF structures, prefer designs where each holding represents a distinct exposure block. Distinct blocks reduce redundant trading and reduce cost leakage. Variable 5. Tax friction and cross-border withholding. For taxable accounts, taxes are costs. They're not part of the expense ratio. They can exceed it. ETF structure can reduce capital gains distributions relative to mutual funds, but that does not eliminate tax friction. Dividend yield produces taxable income. International exposures can create withholding taxes. Fund domicile and treaty access can affect withholding outcomes. Even in retirement accounts, withholding tax can still apply at the fund level for some structures. The point is to recognize taxes as a structural cost that varies by exposure and wrapper. Allocation implication. For international and higher yield exposures, treat after tax, after withholding return as the cost relevant output. A low expense ratio does not control withholding drag. If you hold a highly liquid, broad market ETF, if you trade it rarely, if your orders are small relative to daily dollar volume, then the expense ratio is a reasonable measure of ongoing cost. In that zone, switching funds to save 1 or 2 basis points is often structurally irrelevant. You can lose more than you save through spreads, timing, and tax realization. The correct move is usually to keep the exposure stable. Your main cost driver becomes behavior, not chasing lower fees. If you need a specific exposure and only a few products deliver it, then the decision is about liquidity and tracking quality first. The stabilizing rule is simple. Do not treat the expense ratio as a signal to rotate. Treat it as one input in a cost function that includes interaction and scale. Apply this filter. It's designed to produce a yes or no outcome. You should consider changing the ETF only if all 3 conditions are true. Your realized cost is not fee driven. That means spreads, impact, tracking difference, or tax friction are larger than the expense ratio by a material margin at your trade size and frequency. The alternative improves the dominant cost term. That means the new ETF has tied to execution at your size, tied to tracking for the same exposure, or meaningfully lower tax friction for your account type. A lower published fee is not sufficient. The transition cost is controlled. That means you can switch without creating avoidable tax realization, without paying wide spreads during stress, and without disrupting your exposure target. If any condition fails, do not change the ETF for cost reasons. Adjust execution protocol instead, adjust rebalance frequency, adjust overlap, keep exposure stable. That is the allocation conclusion. Expense ratio is a fee, total cost is a structure. Continue with the next video, it builds directly on this.